The Real Take, your weekly real estate news you need to know. Brought to you by Joe Kehrig, one of the most accomplished real estate professionals in the United States. Sponsored by Blueprint to Success, high performance real estate coaching.
Hi everyone, welcome to The Real Take, the weekly real estate news you need to know. Hi, my name is Joe Kehrig, and before we dive into this week, I want to review again, last week we talked about coming soons and the slippery slope of coming soon and having the different companies kind of hold their own inventory. So if you missed that, make sure you subscribe to our YouTube channel and look at that, because there's been a lot of developments the last couple of weeks. We talked about that. I think coming soon is a great avenue and a great tool that I've used for 40 years, going back to the point where 40 years ago, all we could do was put a coming soon sign up on our signposts, and we generated whatever activity if people drove by and called us on it. But now a lot of companies, as we talked about, are basically making it a huge tool, and sometimes not always in the best benefit of the seller, because my belief is when the home's ready to go on the market, your fiduciary relationship is to the seller, and that home should go on MLS right away. And the problem with all these large companies promoting their coming soon, and the reason they do it, and again, please go back and listen to from last week again, is they're doing it because they want to be at the top of the funnel where people come to them, and that's, again, the gatekeeper of information. Well, the problem with that is we'll end up like Europe, where there's really no buyer agents. You have to go to every single real estate company to find what's on the market. And it would be such a step backwards because we have such great tools with our MLS now. Well, I think that NAR and these MLSs are figuring that out. So Bright MLS, which over on the East Coast has 95,000 subscribers, and now Midwest MLS Real Estate Data has 45,000 subscribers. They have basically said now that if you take a coming soon and if you advertise it at all in any way, you have to put it on the MLS as a coming soon so all agents can see it. I think that's actually a good thing, because it puts it out there. Now, a company can, and so you guys know, National Association of Realtors is going to probably put something in that's going to mirror that. So in other words, what happens is if you take a coming soon, and if it's truly, you keep it within the company and there's no advertisements out there at all for the general public, you can keep it in your own coming soon just for your agents. But the minute you do anything like put it on Facebook, that is when you open it up to the public. It's got to go under these new rules to the MLS, and at least these two MLSs, but more to follow. And I think NAR is going to make it nationwide, which I think is a good thing. It keeps us honest in making sure that everything we're doing has a fiduciary relationship to the seller. Because even no matter what you think about coming soon, if you think it's a good thing, then it's a good thing to open it up to all the agents out there and get as much pre-activity as you can. The only reason that companies want to keep it to themselves is very selfish, because obviously they want to potentially double end the transaction within their own company. So I think it's a good thing. But again, I think we're going to see that where, if companies do coming soon, and if they put it out there at all to the consumer in any way, shape, or form, they're going to have to put it on the MLS as a coming soon. Most MLSs now have a coming soon category, and pretty soon they'll all have it once National Association of Realtors set forth there. And they have to do it, because where we're heading is into a non-buyer agent Europe, where you literally have to go to every company's website to see what's on the market. So that's just kind of an update from a couple weeks ago when we shot the video. This week we're going to talk about profitability in the real estate business, and it really doesn't matter anymore. Well, I can tell you, if owning my own company for 18 years, it definitely does matter, and most people that own any type of companies in the United States will tell you the same thing. It absolutely does matter. But does it really matter to Wall Street? And we saw a lot of upheaval with WeWork. SoftBank is a huge investor in Compass and Open Door, and they were a huge investor in WeWork and for Uber. Well, Uber's IPO kind of fell on its face a little bit, and then WeWork, they actually pulled theirs back. And what's happened now, WeWork has dropped 20 to 30 billion dollars in value because there was no pathway to profitability. And what you're starting to see on Wall Street with Uber and now with WeWork, that companies have to, you just can't hit the stock market now and hope to do an IPO based with no pathway to profitability. So companies like Compass are definitely trying to differentiate themselves from WeWork, basically saying that there's no similarities besides having a pool of investor, their main investor being SoftBank. And I tend to agree with that. WeWork, if you don't know it, is a company that buys, office space and then does individual leasing out where people can come in and do their work. And completely different from the real estate business. The only similarities, I think, are two things. One is that SoftBank is the main investor in both. But the other thing that I think is more important is the fact that finally the investors are basically saying, hey, listen, you don't have to have profitability yet, but you at least have to have a pathway to profitability. And I've seen a lot of changes just within Compass, definitely trying to set themselves up for a pathway to profitability. And now they've kind of talking about, hey, we're not talking about an IPO for a few years, which is very smart because I think that they're definitely not going to be profitable probably in a couple of years, but at least they can kind of turn things around. They're the agents, a lot of the agents that they bought, basically buying up the agents and companies at high commission splits. When those commission splits reset, their contracts reset, they're going to be at lower commission splits. They're starting in my area where they've had 5 different offices in one little town, or a little town of 45,000 people. They have 5 offices. I could walk to all 5 of them because the companies they bought, they're starting to merge those offices and sublease the other buildings. So I think that they're definitely finding that pathway to profitability. And I think that all companies do, but yet the way Wall Street is how important is it to Wall Street? You look at valuations, and Zillow is somewhere worth around $9 billion. When you look at the real estate sector, I'm going to tell you as far as the valuations where Wall Street values these companies at. Zillow is around $9 billion. Compass is around $6.4 billion. Open Doors $4 billion. Redfin's $1.5 billion. Now EXP is around 700 million. Realogy is around 600 million, which their stock has definitely dropped, and Remax is around 500 million. The funny thing about that, on those 8 companies or those 7 companies I just named, the bottom 2 is Realogy and Remax. And yet those are the only 2 companies of the ones I named that actually are profitable. And so, you would sit there and go, well, why are they valued so low if they're the only companies that are profitable? I think because when Wall Street values companies, they're obviously looking at profit now, but they're looking at future profit and where a company can go future, where Realogy has definitely kind of been diving around. Now their partnership with Amazon, what I think was a coup, but they definitely have been diving down. So Wall Street doesn't value them very high, and their stock is just tanked almost from down to $5 or $6, or depending what day you look at it, per share. But they're looking at the future profitability. Where's the company going? And if it's trending down, then obviously Wall Street's going to value it low. The other thing is, the name game. Obviously, Realogy calls themselves a real estate company, and they're at $5 a share. And Compass calls himself a tech company, and they're at $118 a share. Well, hell, for $100 more a share, I'd call myself a tech company too. But in reality, Compass is a real estate company, but they have a tech, foundation to them, and they obviously have a lot of tech people now. Depending what you read, One person says 4%. Compass says about 19% of their people are in the tech part of the company, but it really doesn't matter. The bottom line is they make their income from not necessarily from technology, but as supporting the agents through the technology. So again, profitability does matter in the real estate business, because what you're going to find and what these investors are looking at is when they finally go public, and the 95% of the people like me that don't really follow things that close, 5%, when something goes public, 5% of the people make the money, the people at the top, the people in the know. The other 95% usually lose the money. They're the ones that are, helping the 5% make money. And what's going to happen is Compass and any of these companies like EXP or Open Door, they're going to go public, and they're going to look at it, the investors, and sit there and go, where's the profit? Because I will tell you, in anybody who's ever owned a real estate company or understands it, the profits are razor thin in the real estate business. And then when you start buying agents, I mean, they were okay when you're doing 50-50 splits, but if you're buying these agents and giving them hundreds of thousands of dollars, and then you're putting them on 90% splits, there is no profit there. It's a money loser. But the idea is it's almost kind of like Uber. I've just recently got back from vacation, and one time I was kind of forced to have to take a taxi cab, and man, I see why, Uber should just control the industry, because again, you can call them, what the fare is going to cost. Where when I was in the cab, the guy who took me a couple miles and it was like $15. When I took Uber the next day about 4 times as far, and it was like $18. And I had no idea what he was going to charge me. I think he just kind of made it up. Sitting there going, okay, $15. And it's like, well, no, well, it wasn't $14.50 or $16.86 or no, $15. That was it. I tipped him $5 and gave him a $20 bill. But I kind of felt like I was had after the experience, where, with Uber and the technology behind Uber is, I do think they'll be dominant. Now, obviously, they have to have a pathway to profitability too. And that's what's really hurt their stock. So companies like obviously EXP and Compass and everything, they're really starting to shift now to show, instead of basically building their business wide and keep buying companies and expanding, now they're trying to dive it deep and become profitable, or at least show the investors. Because let's face it, SoftBank doesn't want to be in the real estate business or the iBuyer business or the Uber business or the WeWork business. They're into it for when it goes public, that they make their money, because they have to, the profit they have to make has to go to their investors. So the whole idea of putting in the money is so when they do the IPO, which they will do an IPO, that they get their money plus out of it. And so I think what they're finally experiencing, what happened with Uber and WeWork, is, what? The investors are saying, hey, listen, all right, it's fine you don't have a profitability, but you have to at least show that pathway to profitability. And that's why you're seeing the companies start to say, okay, we're not ready quite to do an IPO. We have to show the investors we can have that profitability. So again, hopefully you enjoyed this week. I want to remind you also to subscribe to our YouTube channel. We not only will do these videos on a weekly basis, letting you know what you need to know, but also there's going to always be a training behind what we talk about, after. So in this one, we're going to kind of back it up with the training of talking about, you have to be profitable. And, and it doesn't matter who you work for, whether your company's profitable or not profitable. Remember, it's you incorporated. And so you have to sit there and have a budget, a business budget, a personal budget. And the bottom line is you have to spend less than you make and then invest the difference. So that's what going to be our training this week. And again, if you did not miss any of these trainings, please subscribe to our YouTube channel. And if you are subscribed, thank you very much. I appreciate it. Can't wait to see you next week. And as always remember to honor the journey.